Happy FOMC day, everyone. There is no mystery. The Fed will deliver a 25 basis point cut later today, but the real intrigue lies in what Fed officials have in mind for next year. Will they signal a gentle path of further rate cuts or hint at a more cautious approach that wipes the smile off market sentiment, and of course, how markets will react to their decision? So welcome to Swissquote's Daily Market Talk. I'm İpek Özkardeşkaya. We are December 10th. We will talk about Fed and other central bank policies and what they mean for markets and investor sentiment. But before we do, and as always, keep in mind that opinions are my own and this is not financial advice. Everybody knows that the Fed will announce a 25 basis point rate cut later today. I know it, you know it, he, she, it knows it, my 5-year-old, my cat, your dog, the birds in the sky, everybody knows that the Federal Reserve will be lowering its policy rates later today. That's given around 88% chance from activity on Fed funds futures, which is just too high for the Fed to step back in the absence of any emergency. But what we don't know is what are the Fed members' plans for next year? How many times the Fed is planning to cut the interest rates in 2026 and whether their prediction will convince the market and investors to react accordingly to their plan. For the Dows, the Fed should cut rates mainly because the US jobs market has been weakening, partly due to the aggressive anti-immigration policy from the White House, the tariff impact on businesses, and the AI-led job losses. The tariff-led price pressures, on the other hand, have not showed up in the data since the announcement of these tariffs in April, and also because Donald Trump is pressuring the Fed and its members to lower the interest rates and lower them significantly, sometimes using quite aggressive and public insults and threats. For Jerome Powell, for example, he's heard things that he never think he would hear in his lifetime. And for the most extreme Fed Dows, the Fed has plenty room to cut the interest rates next year. This is what Mr. Kevin Hassett, who is one of Donald Trump's favorite candidates to take the helm of the Fed next year from Jerome Powell, said yesterday. He said that he believes that the rise of artificial intelligence presents the Fed with an opportunity to set an easy monetary policy, where lower rates could increase aggregate supply and aggregate demand, and the higher supply could tame inflationary pressures. But for the others, it's maybe, but just maybe, better to think before cutting the interest rates further. The AI-led productivity gains are real. A visual capitalist chart, for example, shows how AI tools help workers decrease the completion time of a task for workers using these tools. A task in technology design, for example, that would take 142 minutes to be completed without generative AI takes less than 40 minutes to be completed with the usage of AI. So that will obviously lead to higher supply, and this is why we are willing to use it and not necessarily to booming jobs in the immediate future because, well, you need less employees for doing more work, and the combination of higher supply and subdued demand from workers is going to be disinflationary. But on the other hand, the looming inflation risk from the tariff policy needs a careful playbook if this inflation from AI doesn't materialize fast enough. And careful here means less rate cuts just to prevent inflation in the US from spiking. Because when you lower the interest rates, inflation is supposed to heat up. That's the economic theory. And the US inflation is already near the 3% level, which is higher than the Fed's 2% policy target, which means that the Fed may have never cut the interest rates in September in the first place. So it is complicated. All eyes will be on the Fed's dot plot today. Any hawkish comment or any reluctance to lower the interest rates next year could see a further readjustment of sentiment toward the hawkish side and weigh on market sentiment. The good news is investors are not blindly walking into this FOMC decision. Money markets have already trimmed their interest rate cut expectations for next year for the Fed from 2 to 4 rate cuts to just 2 rate cuts only, reducing the market impact of potential hawkish Fed cut today. For those who are new to this, a hawkish cut means that the Fed will deliver the expected rate cut today, a 25 basis point cut, but will eventually walk back on expectations of future rate cuts, or will cut the rates with cautious or a less accommodative accompanying statement. And a hawkish cut is not good news for the market sentiment. But on the other hand, a dovish cut, if not justified by the economic data and fundamentals, is not better either. And looking at the way the yields behave these days, the message from investors, the message from the markets is clear. Most investors are not buying the dovish Fed story and the idea that lower interest rates will send the yields lower. They rather worry that lower yields today will revive inflation in the future and eventually prevent the Fed from further cutting the interest rates, or maybe even force it to hike the interest rates and hence send the yields higher. This is mainly what we see today, and the proof is that the US 10-year yield climbed since the Fed started cutting the interest rates back in September. And that disconnect between the Fed policy and the market yields suggests that the Fed's lower yields remain stuck on the way somewhere between the Fed and the markets. They do not get well transmitted to the markets. And no matter what the Fed members think or they think they would do, the markets are and will remain worried about inflation. And the implication is that they won't absorb lower policy rates before they see evidence that inflation in the US is under control. And the latter could prevent the S&P 500 from climbing toward fresh all-time highs into this year's end. Then the global winds are also turning hawkish elsewhere. The Reserve Bank of Australia said this week that the question at this week's monetary policy meeting was whether they would opt for an extended pause or hike interest rates, with money markets pricing a rate increase in Australia in June next year, which is a big U-turn when you think that just a month ago, investors were rather pricing a rate cut for the same time next year. The Australian 10-year yield soared past the 4.80% mark as a reaction from around 4.10% late October. Then the Bank of Canada is expected to maintain its rate unchanged at today's monetary policy meeting, but the markets are almost fully pricing in a rate hike by October in Canada on unexpected strength in the Canadian labour market despite the frictions with the United States. The Canadian 10-year yield is up from around 3% earlier this fall to near 3.5% today. The European Central Bank is not expected to lower the interest rates either during the course of next year, and the ECB's Schnabel suggested earlier this week that she is comfortable with markets betting that the European Central Bank's next policy move would be a rate hike. So the European 10-year yield is also hovering around the 2.85% level today compared to around 2.5% in October. Then the Reserve Bank of New Zealand watchers also went from pricing in a rate cut next September to a rate hike. The 10-year yield there spiked from 4% to above 4.60% today. And the Bank of Japan is widely expected to hike the interest rates in Japan at next week's monetary policy meeting, with the Japanese 10-year yield flirting with the 2% scary and psychological mark right now, threatening to pull the rug from under the feet of the US Treasuries, as well as these yields for the Japanese yields could encourage Japanese pension funds and insurers, the biggest US bond buyers, to repatriate their funds back to Japan. So even though equity investors cannot agree on whether there is a bubble forming in the technology space and broader equity markets, global bond investors, they have little doubt regarding the unsustainability of the developed market debt and hawkish shift in central bank expectations for next year. And the latter is pressuring the yields higher, and if the yields continue to push higher globally, the equity valuations could eventually get ahead. And the more leverage the companies, the more debt they have on their books, the bigger the risk of a sizable sell-off. So today's market reaction to the Fed's final decision of the year will likely set the tone for the remainder of the year. Will Santa bring gifts this year or stay snow out somewhere? We will have the answer in a few hours. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the Fed decision. And until then, good day trading and enjoy the Fed day.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.